last year we had $2 trillion of reserves in the banking system. And then this year we only have $1 trillion. So the markdowns are occurring really heavily in terms of what asset values are. And if we get down below, down to 500 million, 600 million from where we are, it's or 600 billion where we are. It's a kind of a disaster in the making. We're going to have to print more money. We're going to have to do more repair to the banking system. So we're not in a crisis like we were in 2008. Banks still have liquidity, but I think you're going to see further adjustments as rates rise in how regulations are going to require even more conservative lending. And I don't know what that means for real estate, other than that can't be good.
Hi, Adam Gower here, founder of GowerCrowd.com and host of the Real Estate Reality Show at youtube.com/GowerCrowd. Welcome to today's episode. My guest is Lew Feldman, who is CEO at Heritage CRETech and is also an advisory board member of CrowdStreet and an early investor in Realty Mogul and Fundrise. He is a wealth of knowledge about both the commercial real estate industry, what is going on today in the industry, and also the impact and history and background to real estate crowdfunding and the impact of what's going on in the market today on that industry. Lew also, so I'm going to date stamp this, even though it's going to be published a little bit later than today. So today is the end of October. So we're basically the beginning of November. And the White House recently announced a new funding program to encourage conversion of offices into residential properties. So Lew talks about that in some considerable detail as well. So if you are interested in how to get hold of some capital from the good old US government, then you're going to learn a lot from Lew today, where to get it, what the terms are, and basically high level, what the terms are, what's involved, and how it is designed to facilitate adaptive reuse of all of these increasingly vacant offices in some of the downtowns around the country. If you want to learn more about Lew and his company, Heritage CRETech, just go to the podcast page at GowerCrowd.com. And of course, while you're there, do please subscribe to our newsletter. It goes out once a week and covers latest news and events from the prior week related to real estate syndication, commercial real estate syndication and crowdfunding. You can always unsubscribe. When you click the subscribe button, though, on the website, GowerCrowd.com, take a look. You'll see some of the companies that our subscribers work for. It's a very impressive list, and we would welcome you to join them. All right, without further ado, here is my great pleasure to introduce Lew Feldman, CEO, Heritage CRETech. Lew, thank you so much for joining me. It's always a pleasure to see you, and I really enjoyed chatting with you a little bit before we got started. Thank you. Let's jump straight in. And what I'm interested in talking about, you hold either advisory board seat or are an early investor in 3 of the major crowdfunding websites, CrowdStreet, Realty Mogul, and Fundrise. So what's going on in the market? What is the impact of what's going on in the market, I should say, on real estate crowdfunding, if I can use that term, as you see it?
Sure, absolutely. Again, thanks for having me. I remember when I first did your program, I was, I believe, podcast 223 or 232, and I still haven't gotten over that I wasn't like 230 or 229, something better than 232. Pretty tough. Anyway, I appreciate it then, and I appreciate it now. And so in terms of what's going on with real estate crowdfunding, there are different kinds. There were, remember, debt and equity separated in different kinds of websites. The debt side included a couple of companies like Patch of Land, which was a fix and flip.
Right.
They ended up being sold to Patch Lending, but the old Patch had loans which were adversely affected by the rise in rates, and they've been steadily working those things out. Then there was Peer Street, which was secured loans or unsecured loans that were syndicated by Peer Street from originators or holders of debt. And that also ended up drying up, and there were issues associated with their business model. Two very bright guys, but they got crunched with what occurred in financing as well, with rising interest rates and the inability of finding people who wanted to make hard money loans at rates that could make sense. And then there are the sites that you mentioned that have done better, have fared better, which include Fundrise. I would put them at a very strong position, probably the leading fundraising program in the country based on a crowdfunding model. They shifted their model. They're really separate REITs. They're able to reach people, though, at all levels of income, unlike the accredited investing. And so I think they have, well north of actual 250,000 investors, or 2.5 million or something insane. Mm-hmm. And they have, like all others, shifted their focus from equity investments at the bottom of the capital stack to taking opportunistic positions. And they have an opportunistic fund that's doing well. It's running at about a 13% clip. And then they have other core funds that seem to be hanging in there. But if I look at the number of redemptions that are going on in REITs in general, you're having historic redemptions since 2011. You've got a ton of people who want out. $20 billion just flowed out, and you're seeing lots of, and it's no different. Anybody who can get money out of commercial real estate is taking it out, and they're putting it into risk-free assets, i.e., T-bills or T-bonds, and short-term is just too attractive. So that lack of liquidity, you don't have as many people chasing real estate deals as they used to. For sponsors, people seeking money, I think the downturn that is occurring through the increase in interest rates may, limit their financing options and have a capital stack that includes what I'm familiar with, which is government assistance. And I remember every time in my career over 40 years, every time there's a big problem, the government steps in with programs. In 1980, the crash occurred due to the savings and loans. We had all those high interest rates. You're a much smarter guy than I am. You knew all about that. And, going through that process, the way that we got through it was the development of private activity bonds, things that could be used to be sold on a tax-exempt basis and take out taxable financing and get the benefit of the marginal tax rate savings. And they did that for mortgages, single-family homes. They did it for commercial office. They did it for manufacturing, et cetera. And while it was an analog time, and they brought, more government programs to the table, it really helped folks get through the Reagan years. And I think if you look at most things today, you're seeing a real need for governmental intervention in order to avoid now a commercial real estate collapse in office and versus the residential collapse that we saw in the great financial recession. For investors, I would say the opportunities to invest in the opportunistic stack today really leads the attraction. People want debt, they want income, just the demographics are pushing for that, and they want it over growth. So if there's a transaction that can be senior in the capital stack on a good asset, you're seeing folks aggregate their money and actually complete transactions. But I would say the bid ask, the bid for real estate versus the asking price has a huge gap. People are in denial, just like last time. They're kicking the can down the road where they can, and where they can't, they just give it back to the lenders. And with liquidity drying up on the regional side, because regional lenders have the greatest amount percentage-wise of exposure to commercial real estate, that has had everyone really. You're looking at loan-to-value ratios that are completely different. You can't get the same money that you could before, so cash-in refis are occurring in a lot of troubled projects. And until the regional banking crisis is remedied, you had this is kind of startling. I didn't know this. Ben Miller actually is the person who gave me this information, and
founder of Fundrise for the one who doesn't know.
Yeah, thank you. And Ben said that last year we had $2 trillion of reserves in the banking system, and then this year we only have $1 trillion. So the markdowns are occurring really heavily in terms of what asset values are. And if we get down below, down to 500 million, 600 million from where we are, it's or 600 billion where we are. It's a kind of a disaster in the making. We're going to have to print more money. We're going to have to do more repair to the banking system. So we're not in a crisis like we were in 2008. Banks still have liquidity, but I think you're going to see further adjustments as rates rise in how regulations are going to require even more conservative lending. And I don't know what that means for real estate. Other than that can't be good.
So look, you mentioned regulations, and that does dovetail. Somebody asked me recently, quite seriously, do you think that crowdfunding is going to be heavily regulated after this downturn? Real estate crowdfunding. So that actually does dovetail into my question. The impact. This is the first deep recession in commercial real estate since crowdfunding was legalized in 2012. So what do you think the impact is going to be? I mean, we talk, with the Peer Street went bankrupt, Real Crowd sold out. What is Crowd Streets have obviously had their issues as well at the moment. Ben is talking about all kinds of things at Fundrise. What is the impact, do you think, on the industry of real estate crowdfunding of going through its first serious real estate downturn?
Well, as you say, it's going to shake out all of the people who don't have a strong business model or who are relying on capital coming from outside investors. Those who did raises and have money in hand, like Crowd Street does, they're going to be able to endure what's going on until we move into that next phase. Fundrise as well. And then what's interesting is all of each of the three crowdfunding entities that you mentioned have all become broker dealers.
Right.
So there's no one who's really just using the crowdfunding exemption of 506C alone. They are now fiduciaries, or they have disclosure obligations. It's very different than the Wild West of crowdfunding in 2015, 2016, 2017. People like, it's interesting. If you weren't a broker dealer like a Real Crowd, you were an advertising company and you were packaging up offerings. You were never trading them. That's what crowdfunding, that was a good model for crowdfunding, but you couldn't take, you couldn't take possession of funds. You couldn't really be an advisor without being registered. Mm-hmm. It was a tough model to operate in on the long term. And eventually they were taken private by a company that wanted to raise money. So they wanted that portion of their, they wanted Real Crowd's platform. And
well, they wanted the list, presumably. I mean, I don't know, but I imagine that the network and relationship that they had with investors was where the real value lied.
I agree with you. It was Scott McNally from Sun Microsystem. He used to say we put the .com. But he said the network is the computer. And I always thought that was very interesting. So they bought the computer of Adam and his game. And
that's right, Adam Hooper, not this Adam. That's
not you. No, nobody.
The other Adam.
No. I am you one day.
So we did talk about this, but I missed that, and I don't like to miss your witticisms, but I did. I definitely want to laugh on cue as well.
No problem.
So what about the impact? We talked about this again briefly before we started today. The impact of having all of these funds, I think, maybe with the exception of Fundrise, but Realty Mogul, CrowdStreet, Real Crowd, to my knowledge, Peer Street, they all took on what I call high octane venture capital. And Realty Shares, of course, was the first, even as the market was going up. Realty Shares that was venture backed clearly failed because their capital realized this isn't going to be a unicorn, right? We're not going to fund anymore. This is real estate. It's a long-term gain. Our money is shorter term. What is the impact of bringing venture capital in? I know this is your business at Heritage CRETech. Because what is the impact of bringing this high octane capital, venture capital, into a business that really only survives if it has a long-term slow growth perspective?
Well, most of these companies now have moved into a different approach than high octane venture. They're more in the C round or B plus C plus round. Had the market been better, I think we'd see more of these companies going public. But they, in hindsight, last year would have been a great time before everything started clarifying that we were moving down. So now I don't know how long it's going to take. We know that real estate transaction velocity has to come back. We know that that different kinds of offerings, equity and debt, fund offerings, curated, good deals, new kinds of protections associated with how money moves. That's one of the good things about being a broker dealer is you can deal with transfer agents and trustees and others and have a greater hand in telling folks what they can and can't do when they can get to their money. A partner, CrowdStreet, for example, has had very few defaults. They've had some problem deals. But the problems have been associated with things that we can track, office in the absolute wrong time going to market. But most of these companies focus on multifamily, and the apartment world's been pretty good. And then build to rent has become big. Fundrise has been investing in build to rent. The higher interest rates go, the better those communities compare with buying. Right now, it makes no sense to buy in a lot of places. It makes more sense to rent. And if you can get a home for your family with a yard, and you can rent that, and it's nice and it's new, versus figuring out a way to get a big down payment. The logic's pretty clear as to why people find that attractive. And I don't think that's going to stop. I just don't see the American consumer of housing, residential housing, being able to afford continued escalating prices. It just can't happen unless the amount of money that's being printed and made available goes way up and interest rates go way down. So the good thing, though, is that from what I gather, because Realty Mogul and made good multifamily calls, and Fundrise made great investments in all over the country in their different funds, and got enough diversification to make it a heck of a lot safer than trying to pick single deals if you're not an experienced investor. And the returns speak for themselves. I mean, CrowdStreet's returns have been in the high 17-18% for a couple of hundred realized deals. Now that's during a big upturn, and we'll see how all these things work out. But oftentimes, the ability of an investor to enter the market at these more attractive valuations, and with a transparent business plan and a good developer or a good operator, that may lead to to people wanting to come in and actually invest. So as capitulation pricing continues, you'll see more deals going on these marketplaces that offer some pretty good opportunities. On the other hand, with Fundrise and Realty Mogul, those are fairly private. They don't allow you to get into their details because they're more funds. CrowdStreet used to be continues to be very transparent. However, because of regulation, things become more fiduciarily driven and less individual choice driven. Suitability and other factors come into play. And, that means they've all changed to a model where it's fund investing and they're able to have people come to them and they make partnerships, or they make a REIT or a fund that does the investment now or does the debt. So they've really developed into financial institutions in some way. And I think that's a good thing. FinTech and PropTech are good things leading to access. But right now I'm seeing a dip in everybody's interest due to the uncertainty that we see, and due to the high risk off rates that the Treasury is providing in an event, actually take corrective action.
Exactly. So now let's move to regulatory changes. It's interesting. We chatted. Just been announced that the White House has. I'm not exactly sure. Well, they've issued there's some money set aside for conversion of commercial real estate to residential. I've only seen the headlines. It's absolutely brand new. I know you know everything about it. What's the? You probably wrote it, didn't you, Lew?
It's like I told you, Adam. Norm MacDonald always said, I don't have any opinions. I just turn on the TV and say whatever that guy said.
That's exactly right. All right. So what did that guy say about this White House initiative?
The initiative that came through recently, I guess it was about 3 days ago, it was announced, was something that is an opportunity to increase housing availability and affordability, and then at the same time champion climate change to move towards zero emission, energy efficient housing. And there are 20 programs that were developed. The public policy that's come in is give about $55 billion to allow grants from HUD housing urban developments, development block grant funds for acquisition and rehabilitation of properties. There's like 10 billion in there. There's a grant program called Pathways to Removing Obstacles. That's my dog.
Your attorney.
Yeah, that's my attorney. Exactly.
Growling in the background.
My partner. So the increases, the pathways to removing obstacles will provide a bunch of grants for adaptive reuse and financing conversions, and those basically, from what I can gather on rates, are about 5% base rate plus a spread. So it's 10-year treasury plus a 2% spread, as far as I can tell on some of these loans that are being given out. And
they're specifically for adaptive reuse, but they have to have some kind of green component as well. Is that the idea?
Well, it can be either. You can do both. You combine them. The below market loans come as a reward for the DOT or for conversions, office conversions that are near or into housing that are near transit zones. So TOD, transient occupied development, is very favored, and the agencies like the GSA, General Services Administration, and the Department of Transportation are basically told that they should take a hard look at all of their property and start selling it for housing development, for affordable housing. So they're going to be doing that, and I don't know how quickly this will evolve, but surplus property is being evaluated as we speak. And those land dispositions, I think, offer some decent opportunity for new development. The other thing that's really important, especially you and I both know being in California, is the ability to expedite entitlements. In Los Angeles, the Ziman Center just did a study, Stuart Gabriel and another professor, on how long the impacts or what are the delays associated with current governmental regulations just to build housing. And before you even start with a deal coming out of the ground in Los Angeles, it's a 3 to 5 year process.
Yeah, isn't it insane? I know. Yeah.
So
how will this help that? Does this override local government
it does.
authority?
Yeah, it does. It for certain projects, it provides a federal exemption. And, in California, we've done that before on a local level, on a state level for stadiums and other things, but it hasn't been done for these conversions.
It's like ADUs as well. That was a state level mandate, wasn't it?
That's right. Yeah. I would love to be able to afford an ADU, but the increase in interest rates makes it hard.
That's right.
This legislation is just advancing, the zero emissions world. But the zero emissions buildings covered through the 2022 Inflation Reduction Act, and that allows for the commercial or the conversion of commercial developments into residential developments, and also enables them to use clean energy and technology to lower carbon footprints. And it's probably safe to say that a conversion from commercial to residential is a positive carbon event, given what would have to occur to build everything again. But some buildings just lack the ability, without a whole bunch of retrofit. They have their cores are too big. You probably know all this stuff, to make it an easy conversion. So money is really needed to, if folks are thinking about keeping the shell and redoing the systems, that's pretty expensive. And the Inflation Reduction Act does include financial resources for that. And then as well, tax incentives are provided under Section 45L and 179D, which are allow you to put in systems and then deduct the energy efficiency improvement costs on a pretty much immediate basis. And then there's another tax credit, Section 48 credit, that allows for renewable energy projects to be developed, including big solar fields. And I know that there are folks who are hunting around California and elsewhere for large enough swaths of land that they can hook up to the grid and provide that clean energy. And then finally, there are below market loans, again, for this side of it, not just the conversion, but also the energy adaptation. And all of this stuff is contained in this program list and guidebook that the White House put out. And if you'd like the link, I can shoot that over to you.
Yeah, I would love to get that link. Thank you. I think that sounds like the biggest impact, particularly here in California, is the idea that you can expedite entitlements, because it really is utterly dysfunctional how long it takes to get entitlements, particularly in a market that is so short on housing.
For sure. Let me see if I can adjust this. I'm now in the middle of the sun coming down. And,
yes, yeah, that's right. The sun is shining on you, Lew.
Yeah.
Oh, there you go. Good grief. Something's happening. Is that you going up, or is it your desk?
Yeah, that's it. I'm just trying to bring it down a little bit. Maybe I can, I don't know. I'm sorry.
Oh, no problem. Something. You don't have shades there on your windows, I suppose.
I don't. I have a beautiful view over the entire valley, and it's hard for me to put shades on that.
Well, I hope that it doesn't bother you too much. Are you still good to keep on going a little bit?
Oh yeah, I'm fine. I just don't want to screw up your podcast.
Oh no, don't worry. It's also audio, so that's fine. Okay. So let's move on to a slightly different topic. I mean, it's interesting. Oh, but actually, what I would like to say is, how long will it be before that initiative actually starts yielding capital to sponsors, or is it already you can apply to HUD and you can get these loans now?
Yeah, you can apply now. They're trying to publish all of these different approaches to create additional housing and to solve like I said, this is to help solve this huge problem with all of these commercial offices coming due, having no vacancies, and an inability to really come back without an adaptive reuse. And at the same time, we have the housing crisis going on because everything's too expensive. So it's always a good time for a program to develop to bring down the cost of financing. And so I think we'll see more conversion bond programs and a lot of debt programs that can be applied by local government, as well as these grants, as a way to save money in the capital stack and make projects which otherwise wouldn't work. But yes, this stuff's available. The White House guidebook has several examples in it of how the capital has been stacked. And Detroit, Springfield, Massachusetts, a couple of other multifamily and office conversions are reflected there, and it's fairly granular.
Interesting. It'll be interesting to see how those roll out, particularly in a market where there's so little liquidity as well. It's nice to bring some liquidity in. As long as you don't, if you want to put sunglasses on, just feel it'll look really cool. If I had mine here,
I'll just move over.
If I had sunglasses, I'd put my shades on so you wouldn't feel uncomfortable wearing shades.
You're too cool for sunglasses. There we go.
Too cool for school. Yeah. All right, that's right. So now, as we continue talking, you'll just follow the sun.
That's right.
I'll just have to keep turning to the left here as well as talk. All right, so let's do.
What was that song by Jerry and the Pacemakers? Tomorrow may come, so I'll follow the sun.
That's it. So you're following the shade.
Yeah, I'm following the shade. That's right.
All right, so let's switch a little bit and talk about this. So crowdfunding. One of the first questions, I just had an interesting conversation with Ben Miller some years ago about REITs, and he made the interesting observation about the liquidity premium. I'd never heard about that before. The liquidity premium on REITs, but in the context of the market today, REITs taking a hammering, private real estate, private equity markets, and commercial real estate also taking a hammering. How do you compare these two markets, private real estate, again specifically crowdfunding and syndications, and REITs? What's going on in those two markets as they compare to each other?
Well, REITs being publicly traded clearly are they're instantly liquid, or within 3 trading days, and they clearly react a lot more swiftly to macroeconomic indicators and market sentiment than the private market does. The non-traded REIT doesn't have the same kind of disclosure. They have a once a year update as to what the property is worth. They tend to have, in the past, high management fees, high exit fees, and limited ability to exit. Things have changed a little bit. They're more liquid on the non-traded REIT, but still, it's hard to get your money out. And as everybody runs toward the doors like a Who concert, things can get pretty messy and people can get hurt. Right now, I think the private market is suffering from a lack of access to funding. And as I mentioned before, refinancing the 2022 loan-to-value ratios, it just isn't the case. What used to be 80% loan-to-value is now 65% loan-to-value. Mm-hmm. And that's a big amount of money when you want to refi. And, we're talking about banks and thrifts are going to see $270 billion worth of loans that are slated to mature. Mm-hmm. And that's just this year. Next year, about the same amount. It'll go up to, it'll just keep going. And I don't know how values are going to keep up with what they did before. But we're definitely going to see a test of those kinds of assets as we move forward. I think multifamily REITs have the greatest access to capital through the governmental service center, the GSEs, and Freddie and Fannie are doing a yeoman's job, but they're not the biggest lender out there. The regionals and the banks are the biggest lenders. And insurance companies, as you pointed out, are just taking it in the shorts lately in Florida and other places where they have to pay claims, but yet there's record money being made by these insurance companies, and the loans that they're making, they're going to have to take back properties, but we'll see how that all works out. But the public nature of REITs offering this greater level of transparency is a benefit and a burden. Ultimately, it's supply and demand and product type that's going to lead you to invest in a REIT. They're fairly specific: industrial REIT, multifamily REIT, office REIT. The idea of having a hybrid REIT that existed prior to 1994, I don't think that's coming back anytime soon. And I also don't think that crowdfunding sites that are sprouting today, I'm not sure that without a broker dealer, they're going to do as well as they could do. They're going to face a lot of obstacles. So when you're looking at the way that the crowd views an asset, there's transparency, but there's not breadth. Oftentimes in terms of knowledge, so you're trusting the operator. And in the case of Fundrise and Realty Mogul and CrowdStreet, that's not a bad thing. Although when you're an accredited investor, you really need to do your own diligence on these transactions, and more importantly, the filter that each deal goes through. CrowdStreet had an issue associated with Nightingale. Ellie Schwartz, a young Manhattan real estate developer, got really extended on office projects, and then figured out a way to take the money that the crowd put together for a couple of office buildings. He took that money, bought a penthouse, tried to pay off his other loans. Everything was collapsing on him. And, it's hard to deal with fraud, especially when somebody has a big track record and owns things. And it's just really, really difficult. On the other hand, an escrow program through a broker-dealer can now prevent these kinds of things from happening in the future, as well as an understanding, a real deep dive into who it is that's taking your money. My law partner, Bruce Graham, a wonderful guy, used to say, a fool and your money are soon partners. and you have to be careful. It's still, caveat emptor with a lot of these things. But the more transparency that exists in the public markets creates a demand for greater transparency in the public markets. But there is a lag, and I think that if you're an office building owner right now, you got to look at alternatives. Office buildings in urban settings, office buildings in other settings still are doing well, although footprints are being modified downward, as you know. So that's kind of the thing. Also,
so where do you think, Lew? Where do you think the market? If you don't mind, let's. I would like to ask you one question that, as we wrap up, one question that I like to ask because you can't get it wrong. What are your predictions for 2024 for the commercial real estate? And if you get it right, we'll revisit. We'll talk about what you said, and if you don't get it right, we won't talk about it ever again. But what do you think is going to happen in 2024 in commercial real estate?
Thank you. I have my magic 8-ball.
Oh, you really do as well. Yeah, just shake it and see what it says.
I'm just going to tell you that it says yes. I don't know that.
Right. Yeah. Well, that's a positive note anyway. Yeah. There's nothing else.
I think we're going into a decline in the stock market, probably in 6 to 8 months. A recession is not a leading indicator, real estate rates can cause recessions, but you don't know until afterwards. But typically, when you have rates that are as high as they are today, it does have an impact about 6 to 8 months, maybe 12 months later, on how the economy is doing. So I view 2024 as a test year. The wild cards, of course, are war, internal strife that we have here,
an election
coming up. I mean, there are a lot of factors that are going to make it an interesting year. The Congress is obviously set up in a manner that allows both the far left and the far right to have veto power over a lot of things, and especially on the Republican side right now. That's creating a completely dysfunctional government, and to me, it's the equivalent of civil war, and that concerns me greatly. I don't feel like 2024 is going to be a big turnaround. I don't think things are shooting up, and the notion of higher for longer is going to continue. But eventually, the cycle will reset, or government programs will come in to further the recovery of real estate, of commercial real estate. I just don't know how it could be otherwise. Either the system will work or the government will figure out ways to feed it.
Lew Feldman, CEO at Heritage CRETech. Thank you so very much. Such an enormous pleasure to see you again. Thanks for joining me on the podcast.
Oh, thank you so much, Adam. I really appreciate it.
That was Lew Feldman, CEO at Heritage CRETech. What an interesting guy. Has an incredibly good sense of humor. Came across a couple of times during our conversation just now, but his and my email thread just setting this up has had me in stitches for the last week. He's a real pleasure and a very interesting fellow. Lew, thank you so much for joining me. I really do look forward to meeting you in person sometime soon. And thank you, dear viewers, for joining us today. I'm grateful to you also for spending your time on the real estate reality show, listening in to what we have to say here. That's it for today. Of course, I have to mention, do go to gowercrowd.com and subscribe if you've not done already to our newsletter. That's a kind of mandatory thing that I have to say at the end of every podcast. So I've said it now, and therefore, until next time, this is Adam Gower signing off.